This is Declarations.
We see our institutional investors behaving and acting differently or wanting different things than some of our family office investors. And the family offices in LATAM have grown tremendously over the past several years, been huge wealth creation. And I think oftentimes they look for different things, which makes sense. I think they're still looking to offshoring assets and still looking to invest in safe, developed markets, mainly the United States.
Hi, this is Todd Rich, and welcome to the Declarations podcast. The purpose of this podcast is to engage with thought leaders in investing who provide an independent perspective. Our goals are to explore the foundation behind their success, to understand the source of their inspiration, and, through these conversations, to become better investors. We hope you enjoy this episode. We're excited to welcome Les Baquiran and Danielle Mueller today. Les and Dan are co-founders of Alpine Capital Advisors, a placement agent and advisory firm with offices in New York and across Latin America. Les heads up the New York office, and Dan heads the Latin American business, with offices in Santiago, Mexico City, and Sao Paulo. Alpine advises and raises assets for fund managers and companies across the globe, and maintains strong relationships with allocators across North and South America, Europe, and Asia, to include single-family offices, multifamily offices, fund of funds, private banks, and RIAs. I'm proud to say that Declaration has partnered with Alpine to meet investors in Asia, Latin America, and elsewhere for our real estate business. When they aren't managing their own business, Les and Dan are busy managing their collective 7 children. Les moonlights as a rock star, and Dan speaks multiple languages. Les and Dan, welcome to the podcast.
Thanks, Todd. Great to be here.
Hey, Todd. Thank you.
So as you guys know, we named our business after the Declaration of Independence. It's a document that lays out the foundation for American society, as well as, I would say, the aspirations for our future. So I'll start with Les. What is your declaration?
Thank you again for having us on. I don't want to get too philosophical about my personal declaration, but I want to maybe backtrack into what Alpine's sort of mission statement is, or declaration. And I wrote it in our launch letter, which is on our website 10 years ago. And it's to offer compelling opportunities while sharing dynamic intelligence and building unique ecosystems. So it's really interacting with the GP LP ecosystems in unique, interesting, and compelling ways, which is all probably a lot of marketing babble, but I hope we can get into the specifics of it later in this conversation.
What were those 3 things you said? Dynamic intelligence,
Compelling opportunities, and unique ecosystems.
and unique ecosystems. All right, we will touch on all of those during our podcast. Before we do though, Dan, I'd like to hear from you. What is your declaration?
Yeah, thanks, Todd. My declaration, I would say, and I'm maybe more on a personal level, is be a good father, be a good family man. In general, treat others with respect and be positive. I try to bring positivity always to all the different aspects of my life, both personal and professional, which I think is important.
I love that. We could all use a little bit more positivity. So we're going to come back to these comments, your declarations. But before I like to go back to the origin stories. And in this case, I'll highlight something that I find interesting, which is that you are both from immigrant families. Both of your families moved to the United States. I think that that's a perspective that has helped you shape a global approach to your business. So can you just each tell us a little bit about your childhood and how that immigrant experience has influenced each of you, as people and as professionals?
My story is I grew up in Michigan. I have a half immigrant family. My mother's side of the family is from Michigan and had lived there for some of the generations or around the Midwest. And my father's side of the family is from Colombia. I never lived in Colombia. I always grew up in Michigan and in the U.S.
That's Colombia, the country.
Correct. Columbia with as the t-shirts and the hats say, Columbia with an O, right? Not Columbia, like Columbia University in New York. And I grew up in a small town in Michigan. And so I think I was a bit different. And I think that absolutely shaped how I grew up and maybe how I saw the world, right? And I think that I always had a more of a global or, international or kind of just a bigger perspective on things than just small town Michigan where I grew up.
Is there a lot of other immigrants generally, a lot of other Latinos in Michigan where you grew up? No.
Very, very few. At the town I grew up, very few. And, other parts of Michigan, sure. But the place I grew up, no. Very, very little.
Got it. And Les, what about you?
Yeah, similar story, different part of the world. My parents came, they were doctors, and they were actually during the Vietnam War, there were a shortage of doctors. So US government went out and recruited doctors all over the world. And my parents were two of them. And they grew up, my father in particular, in very humble beginnings. I don't think, actually, I knew he didn't have running water or lights when he grew up. And he would always let you know it. So I think definitely my upbringing was one where they were both doctors, so we lived a relatively nice lifestyle, but they would always remind you of sort of where they came from.
And where was that? Where do they come from? Is it China and the Philippines? Is that?
Yeah, yeah. So they met in the Philippines, but my mom was one of only 9 children who wasn't born in China. They immigrated there. And if you know your world history and during the 40s, you probably know what was going on there. So, and my dad grew up in the, far away from Manila in the Philippines in the northern provinces, which were not modernized. So he didn't have any running water or lights when he initially grew up, especially during the Japanese occupation. And the reason why I tell these stories is just because they kind of ingrained these stories into us and how they kind of grew up. My dad had 13 brothers and sisters and not a lot of resources. So I think the combination of the 22 children, we have 7 kids between us, but they had 22 brothers and sisters, my mom and dad. And
You have 4 only. Do you feel like you're just getting started? I mean, are you ashamed that you don't have 13?
well, back in the day, I mean, you had to have a lot of kids to kind of work the land because most people were farmers. Now, I think if you had try sending 13 kids to private college, I'd have to do a lot more than placement agency to kind of keep their mouths full and tuition's paid. So in any case, I mean, they just built a strong work ethic and a sense of humility. And I think and we'll talk about it later, but the similarities that Dan and I have, I use the word scrappy, a fancier word is being resourceful or creative. But I think that immigrant experience definitely kind of built that scrappy DNA in both of us.
Let's explore the scrappiness, as you call it. So you grew up, as you said, immigrant family with all these stories of, hardship growing up. But with doctors in the United States, you ended up, I assume, well off enough that you ended up going to great college. You got into investing pretty early. You started your career, if I remember, at Brown Brothers Harriman. Then you were at Evercore, Blackstone. Can you just share a little bit of story of what drew you into the investment business and the world of finance?
Yeah, it actually was an accident. I wanted to be a journalist. And so I interned at Bloomberg, and to date myself, 1997. Now, I was there to study the transition of sovereignty from British to Chinese sovereignty. I was in Hong Kong. The real story that year was the Asian financial crisis. And I think just sitting on that news desk and as you guys know, Bloomberg's clients are traders and portfolio managers, and we'd have them walking through the office. The kind of world of finance and kind of was very interesting because you saw it on your screens in real time with currencies dropping 10-20% a day. And so it sounds a little morbid, but that out of that crisis and out of all the chaos and all the kind of things that were happening back then, I developed an interest in finance, which wasn't my major. My major was government, and immediately went back to school and took as many economics and financial classes as I could to change my major.
It's amazing. So you were observing firsthand the Asian financial crisis of the late 90s. And instead of running away from finance, you were so fascinated that you said, I want to get in as well.
Yeah, I mean, it was amazing, right? Because you'd also see other people, and I think if you go back to your financial investing history, you'd see a lot of people who did well during that time. I mean, I think the number one person that we all know is the guys at Soros and Stan Druckenmiller and guys like that. So there was always, I guess, money to be made and lost, I guess, in chaotic situations like that. And it was an interesting dynamic that I hadn't been too exposed to, and so sort of marveled at it in real time in 97.
Got it. Now, Dan, you were not at Bloomberg, but you were at a different information technology company, right? So you started at Thomson Reuters, I guess, where you moved to, I think you started in New York before eventually moving to Santiago, Chile. And so I guess you had a similar enough role, but then eventually you worked to Moneda, which is one of the largest, Latin America's at least largest independent investment managers. So what's your journey? How did you get into that?
Yeah, it's funny listening to Les say that. Another, similarity, I guess, in our career paths. I started at Thomson Reuters in 2006. Another interesting time in world global financial markets, right? I didn't get into this industry on purpose. It just kind of happened, and was excited to move to New York with Thomson Reuters as a training program I started at. And that was obviously a very eye-opening experience, having growing up in the Midwest. I also went to college at Indiana University in the Midwest, the business school. So I was working there, and then another kind of not on purpose thing happened. I was offered to go to Santiago, Chile after 3 years of working at Thomson Reuters. It was more of a promotion role. So it was more working as a relationship manager, sales and service role, where I was kind of more on the support side, or younger in my career. And I was a young, single person living in Manhattan. Manhattan was tough at that time, right? Because of the GFC. And so I moved to Chile in 2009. I didn't know anybody there, literally not one person. Coincidentally, I'd visited the year before. And so I moved and thinking I'll go, and if it works out, cool. And if I don't like it, I'll just go back, a year later, and everything's fine. No big deal. I was 24, no kids, no wife, no nothing. And I moved to Chile then. And I had the fortune of meeting the firm that you mentioned called Moneda Asset Management soon after I arrived to Chile. And Moneda was, at the time, the largest and best and most prestigious independent asset manager. I say at the time because they're still the best and most prestigious, but no longer independent. So I was hired along with one other person to help build out their international presence. I was based in Chile, living in Santiago, working with investors, traveling to Peru, Colombia, Brazil, Mexico, etc.
That was to find investors who might want to invest in Chile, or that was to...
Originally, yes, it was find investors that wanted to invest in LATAM. The funds were either Chilean funds or Latin American funds, by either equity or corporate debt. And then very soon after I arrived, segueing into what we do at Alpine, the firm launched a placement agent business and third-party distribution business, and I was a bit involved in that. And so I saw that business, again, this is around 2010, 2011, starting that. And that's when this business in Latin America really, really started to take off. So
you arrived in Santiago 16 years ago thinking you'd give it a shot, and I guess it worked out so far. So you guys both mentioned that you started your careers at a time that had a bit of disruption in financial markets, right? Boom times, then a shock. Times got pretty tough in the world of investing. Now, in both cases, following that period, boom times came back again. If you were a long-term investor, it would have ended up being fine and, sort of reached new highs after that. Do you see parallels to today? Do you see, a similar set of opportunities emerging now?
I'm a big student of Warren Buffett, and he's a guy who always talks about like it's impossible to time the markets. I don't think we're coming towards something like a financial crisis like I experienced when I was an intern, talking to people, my investors, talking to people even like you, Todd, is that I don't know if we're going to see something like that, financial crisis, but it's been a great market since 2010. So it's been sort of an almost uninterrupted 15-year bull market. So a little volatility is probably a little healthy for the market to kind of take stock. I think everyone has been shocked and surprised about how well the markets have done in the last, not even the last 15 years, but even the last 2 or 3 years. What we do here at Alpine to make sure that we're always in the market presenting things is really having a very balanced book of diversified opportunities across asset classes, geographies, and even size of funds. So I think we try to insulate our business. It's not always possible to do, but we always have a lot of different things that are cyclical, counter-cyclical, semi-cyclical, so that we ourselves are kind of quote unquote running a diversified book of opportunities where that clients can take a look at.
Got it. That makes sense. Let's come back to that, because I want to spend a little bit of time about how you approach your clients and how you think about offering them access to opportunities. But before that, I guess we should get to the origin. You guys were in different places, right? Les in New York, working at Blackstone, I think, then in Santiago, Chile at Moneda. How did you meet?
For your listeners who don't know me, which was pretty much everyone, I'm a short budget Asian guy. And obviously I covered Latin America, but I started covering Latin America when I was in capital markets. And then when I joined Park Hill, which was a division of Blackstone, there weren't a lot of people who were interested in covering Latin America. So I did. I knew Brazil really well. And a Brazilian investor of mine moved to Chile to run their office. And I said, I'd never been to Chile, but I want to because seems like a lot of opportunity there. And so I scheduled lunch with him on a Sunday, and he said, well, you mind if I brought along a gringo, which I'm sure your listeners know what that is, an American, a white guy, to lunch. And so the first two people I ever met in Chile were this guy and Dan. And it was just, you're a
Dan
gringo.
was the gringo, so
Dan was the gringo, yeah.
The half Colombian, with living in Santiago.
Means American, as you know. And so it was just like gringo to gringo, American to American. We met at lunch, and I've been talking ever since.
Got it. And what year was that?
I think that was 2010.
And so clearly you built a relationship together, you had a shared vision, but what was that vision? What was the gap in the market that you saw? And talk about the motivations that led you to both leave your current positions and to co-found Alpine.
I launched Alpine a year before Dan came on board. Dan actually was interested in coming on board, but I said, this is going to be a hard slog. So you might as well take one more bonus payment and join me in a little bit. Interestingly, he resigned on a Friday a year later, and then I landed in Chile less than 24 hours after he resigned, and we started kind of building the firm. And, our vision, and Dan can get into it more on, because it was a two-pronged vision, and he can get into the second part, which is because our business has changed a lot, was that we saw a lot of interest in people investing in Latin America, and we want to raise capital for those opportunities that were local, so funds and companies. And the second part of it was that we want to raise money from Latin American investors. As it turned out, the second part became the business, which it is today. We still raise money for Latin American opportunities, but because of the market dynamics, the currency kind of fluctuations, volatility, things like that, the real business has been, and Dan will get into it, raising capital from investors. I think, as the great philosopher Mike Tyson said, you can have a plan, but things change when you get punched in the nose.
So investing in Latin America was sort of like getting punched in the face. Is that it?
Well, I definitely think if you take a look at the currency action of most Latin American countries, a lot of those currencies have been punched in the nose a lot in the last 10 years.
And has that led to actually the opposite, which is for Latin American capital to, voluntarily try and leave, maybe invest more in the US or in Europe? Has that been, sort of the other side of your coin?
That's absolutely what has happened, and has only increased in the past several years, both because of local issues and local, last mentioned currency, a lot of political issues. We've swung very, very left in a lot of the countries in Latin America. So both because of that, as well as global, the US is dominant in the past 10 years or so in return. So all the money now is flocking out. As Les said, we saw the opportunity to do both in the beginning, right? As we both had experience, and then, both ways, north to south and south to north, which no one was doing at the time. And certainly most of our business has been outflows from Latin America to invest in US, or let's say just global firms. The market then was very, very different than it is now, especially in the market we focus on, which is private markets or alternatives. That was just in early stages in 2010, 2015. The pension funds and to some extent family offices, but local investors were just starting to invest abroad in big brand name private equity firms. And I saw that. I didn't know what a placement agent was until I met Les at that Sunday lunch, right? I saw a huge opportunity to kind of bridge that gap, right? And provide more than just a connection, which a lot of our competitor firms at the time knew somebody locally and could get access to a large global asset manager and would do a meeting or a connection, but to go much more beyond that. And I think that was kind of our vision always originally, is to provide value both to the investor, the LP, as well as the GP, much more than just an introduction, whether it's helping them with diligence, whether it's the network effect that Les alluded to earlier, and a lot of different things. And so I think that was like our original vision. And me, with my unique background, right, is like half Latino, half gringo, living in Latin. We thought it would resonate, right, with both with our global investor GP clients as well as in the local market with investors.
So let's delve into that. You mentioned sort of your core offering as being a little bit more than just placement. Les, I'm going to go back to the items you mentioned. I think if I got them right, you said compelling opportunities, dynamic intelligence, and unique ecosystems. So can you explain each of those three items? How do you view them? And how does Alpine connect investors with those three items?
So the first one I'll spend the least time of because it's a little self-serving and it's obviously very subjective. We try to align ourselves with the best managers that are looking to partner with our investors in different parts of the world and different investor types. And that's across asset classes and geographies and opportunity sets. And we can get into that later. The second two are the ones that are maybe less intuitive. So dynamic intelligence and unique ecosystems. And I think it all falls under the rubric of being holistic in your approach to clients, and that clients, they want to do business with people they know, like, and trust, people that care about them organically, that don't just sort of crawl out from under a rock when they have something to sell them. So we try to find ways to have just constant and organic dialogue with them and offer them things that are a little differentiated. There's tens of thousands of managers, and our challenge is to really try to stay connected to our investors. But how do you do that in a world full of noise that's very competitive? And our solution is to try to find great managers, provide our investors with unique insights and intelligence, and then try to connect them with a whole host of different types of people that could help them connect the dots and help them not only with their day-to-day job of investing, but help them develop some tools and resources to help them with their careers. So for instance, their knowledge of systems and software, their use of AI in their day-to-day life, or even perspectives on careers and compensations, which is something that, we all think about, but from an LP perspective. So it all falls under the heading of, I think, holistic, to try to be really helpful to your clients. And if you are helpful to your clients, they will be, I think, much more receptive, and the marginal propensity to hear what you got to say on the investment side is much higher.
One way to think about placement agent is someone who is brokering a particular investment opportunity. And what I'm hearing you say is that's actually not what you're doing. While it's true that you do provide access to those opportunities, what you're really trying to do is build an ecosystem of trust, a network where people can learn from one another. It's not that the investing is besides the point. It sounds essential, but it's the ecosystem around that. It's the trust and the relationships that you build that are more important.
The length of time that it takes to get to know a manager also has kind of been elongated because there's more options. And so as a result, it takes a long time and their chances are not super high that you'll get them to invest. I think if you ask your average LP what percentage of funds they invest in that cross their desk, they would say something like 1%. So how do you kind of improve your ability to transact with that LP? I think it's time. It's you talk to them for long periods of time, for them to get to know you, for them to get to know your managers, because the chances are that for you to meet an LP and transact with them in the very short term, your chances are pretty low for them to want what you're selling at that exact point in time. That's especially true with the very mature and sophisticated investors, many of which that I cover in the US that are endowments, foundations, and family offices that have been around for many decades. We're trying to build that in Latin America and other places in the world, which Dan mentioned when he started. A lot of the people were just making their first investments into alternatives.
Let's hear from Dan, but I'd like to come back to this question of the long sales cycle. Dan, what are your thoughts about how to differentiate?
I would say that we embrace the differentiation. It's one of our key things at Alpine is we are different. Just speaking of our Latin American business, right? Our competitors are all firms run by local people who grew up in that specific local country. They may have now branched out to different countries and have offices different places, right? But we have purpose built from the beginning, created a true regional, in the case of Latin America, and of course, integrated with our global business. And that has been great for a differentiation and great for this long sales cycle, right? Because Latin America is if not the most, cyclical place in the world, one of the most cyclical places in the world, right? So one year, there two or three, four countries are kind of slowing their commitments, or maybe they do not have any space for new managers. But in other places, it's trending the opposite way, right? And that happens year after year. It's like ebbs and flows, ups and downs. And I think that from the beginning, we really wanted to have this regional platform and be a, kind of one-stop solution, if you will, for global GPs looking to raise money in Latin America. And I think that has paid off for this exact point, because sales cycles are increasingly long. This, might be just in conjunction with like the maturation of our business, but things take forever. They take very long. And I think things are taking longer because there's less space today for LPs with new managers.
So what can managers do? Is there anything that a manager could be doing or should be doing to try and create the same dynamic with their own investor base?
I think firms like yourself, like Declaration is doing it. I mean, you take investors that are family or family oriented. And as a result, I think you're trying to create a very unique ecosystem of both US and international family offices that can share best practices, idea generation, investment flow, and can also help out the portfolio. So from that perspective, you've chosen to take a very specific and very deliberate type of investor, which is family offices, which is also a very large and fast growing segment of the LP base, and trying to also create your own unique ecosystem. So kudos to you.
Very kind. So you both touched on how long things are taking, the need to develop trust, the fact that investors, allocators have so many managers to choose from. Does this mean that the larger firms that already have huge AUM, huge brands, they just have an intrinsic advantage, and it's harder for newer managers with a differentiated vision? It's harder for them to even get noticed? And how do you view the landscape?
I definitely think it's taking longer. And the most significant implication of this is that managers will sort of always be fundraising. So that was not the case, let's say 5-10 years ago, where you would raise your fund, you'd take a little break, you would focus on the portfolio, and then maybe 6 months, 3 months before the fundraise, you'd call your existing investors, you'd have your first close, you'd engage a few new clients, you'd raise your fund, and you'd move on. You'd lather, rinse, repeat. I think, and when I was at Blackstone, I don't think I'm giving away state secrets here, but the first day of the new fundraise was the day after you closed the fund of the previous fund. So you'd raise, let's say, Fund 7 on December 31st. Jan 1st was the first day you're marketing for Fund 8. And I think that is the new dynamic.
One could argue that that's positive for investors in that it creates a dynamic where the investment manager is always looking to communicate. And so if you believe that you're creating an ecosystem of communication, that's really positive. One could argue the opposite, which is that it means that the managers spend more of their time thinking about fundraising, thinking about the operations, thinking about marketing and positioning than they do on investing. And how do you view that?
I think that's absolutely true, that investors either have to spend more time with clients or like the GP, or they have to hire more IR marketing resources to do that. But I think, that doesn't sound great for a GP, but I think some GPs have said to themselves, well, listen, if I'm going to spend all this time marketing, why don't I start new products so that if I'm always marketing, I can market other things? Firms like Carlyle, like Blackstone, I think very early on, and this is the reason why they grew so rapidly, is they saw the advantages of cross marketing and launching new products to kind of get a higher return on time, so that you would not only just be selling a private equity fund, but a credit fund, a real estate fund, an infra fund, so on and so forth.
Well, clearly that makes sense from the GP perspective, right? If you have to spend that much time, you may as well leverage off of it. And particularly if markets can be cyclical at times, and to offer different products at different times makes a lot of sense. I guess the question is, for those investors who want to focus primarily on investment return, or for those managers who want to focus primarily on investment return? Is this a negative?
I don't know if it's a negative. It's just this is the new way forward. This is the rules of the game. You have to have more investor relations, better communication, more transparency. So I don't know if it's a negative for the GB. Maybe it's more expensive or more time consuming, you could say, right? But I think that is absolutely the reality going forward. Do the big keep getting bigger? I think that absolutely will happen for sure. But there's also space, of course, for smaller, more specialized firms who are different and can really add value to the investor, whether it's just from an investment perspective, whether it's from a communication perspective, or a variety of different ways.
Yeah, I mean, I think what your point is that maybe being scrappy can be an advantage, not just to you guys as placement agents, but also to those, smaller, nimble managers who are able to navigate in a different way. Let's talk about some of your investors more broadly. You started your business with a north-south flow, Latin America, obviously being the focus, but your business has evolved over the past 10 years to be more global. Let's just talk about how that evolution happened and maybe some of the trends that you're seeing from different investors from different parts of the world.
I think we all know that the world is getting much more global, like the balance of power of wealth is changing. Asia is becoming a larger part and either is or will become in the next few years the largest economic region of the world. The Middle East and Europe are also significant. So I would say this, like I started this firm in part because I knew that the world's becoming more global. But when you work at a large firm, you usually have people who have fiefdoms of coverage. And, you can't talk to an investor in Asia if you work in New York because you have to keep some order amongst your sales force. I had traveled to places, not only Latin America, but to Asia since the early 2000s and wanted to connect with my old clients. Also, I had always wanted to do business in Europe and in particular London, where I have a good friend. I'm going to shout out him. His name's Rahul Mutdal, who's sort of not only a friend, but a mentor to mine. And if anyone listens to another podcast, Capital Allocators, you'll know Rahul, who's a frequent guest on his podcast. And starting your own firm allows you to kind of open your horizons and travel the world and meet investors over that place. And it falls nicely into our mission of creating these unique ecosystems because investing is global. We want to connect our investors from the Americas to investors in Europe, Middle East, Asia, and those investors to investors in the Americas. And as a result, I think in general, like people will have a better experience by learning from each other. I just came from a recent trip in the Middle East and Asia, and it's interesting with all this geopolitical change. I definitely felt a notable and meaningful change in investor sentiment in both the Middle East, but especially in Asia.
In what way? What are they saying?
Well, I think sort of like what Dan was talking about in Latin America, there was a lot of movement into pushing as much as you could into developed markets or in US in particular. There was sort of like and maybe this is because the Chinese markets have done well, but there was a re-examining or a reinvestigation or at least a spending of more time to see if opportunities that are more local in Asia were once again compelling, and also an opening to see what was going on in Europe. So like, are there other opportunities outside the US that were interesting? And the European markets also have done well. It was a meaningful change.
Meaning in 2024, the clear view from global LPs was to invest in the United States. And now some of the Asian and or European LPs are thinking about re-examining.
Yes. Everything that worked in 2024 that hasn't worked in 25 and vice versa. So things like Europe and Asia and even value and growth, they've sort of switched sides. So there is some little bit of recency bias. I think that affects it, but there's definitely a change. And you have to stay on top of those changes.
And Dan, is that true of Latin American investors, or are they still looking to invest outside of the region and more into the US?
I think they're still looking to offshoring assets and still looking to invest in safe developed markets, mainly the United States. I think there's a big dispersion between the type of investor, right? So institutional, we see our pension fund investors and insurance companies are kind of institutional investors behaving and acting differently or wanting different things than some of our family office investors. And the family offices in LATAM have grown tremendously over the past several years, been huge wealth creation. And I think oftentimes they look for different things, which makes sense. They have different rules they have to abide by. And
How do you see family office investors differing from the institutional counterparts? What are they looking for?
each family office has its own mandate and is different, which I think is a good thing. And that's kind of the answer to the question, maybe, in the sense of people I think they're looking for closer relationships with their counterparties, whether it's a GP or a placement agent or whomever, trusted relationships. I think they're looking for more than fund investments, right? Whether it's co-investment, whether it's doing direct deals, whether it is working together to, co-underwrite an opportunity or whatever it may be. Usually the family office has less constraints. Therefore, they want more flexibility. Maybe on the opposite side, the institutional investors, they have a rigid set of guidelines they have to abide by, and therefore they can only do things that fit in those guidelines. With the families we see, it's definitely different, their behavior and actions and I'd say desires.
And what are you seeing now? You mentioned the recency bias less. The movement towards Asia or towards Europe might just be because of recent movement in the market. How do you think long-term investors see it? Do long-term investors still see that investing in the US and private markets is a positive thing? Do you see long-term investors differing? And are family offices seeing that different from institutional investors?
Sorry if I maybe made it sound like there was a tectonic shift. It was more like sort of like a notable shift. I think the geopolitical winds that are kind of blowing have long-term implications. The markets cloud your biases, but I think that these geopolitical trends at play are sort of forming or reforming or changing the worldview of some investors, at least on the edges. But generally speaking, I think people will always want to invest in the US. There was an interesting conversation in one of our town halls that we had on January 1st. People were like, are you just going to capitulate to invest in large cap tech, US tech? And some people said that's the trade that has worked for the last decade or so. Any type of other investing has not done as well. I think we come to the realization that we're going to do that because that's what we think has worked for the last 10 years and will work maybe for the next 10 years. I think that has changed. People are saying that might not be right. And whether it's active management, investing in EM, investing in Asia, investing in Europe, or even investing in other things than equity is sort of things that people are really thinking about.
What is your expectation there? Based on your intuition and the conversations that you've had, where do you think people are going to focus over the next 10 years? What are people thinking now?
Yeah, I mean, it's very hard to generalize, but in this market, because I can't, looking out to 10 years, that's really hard. But I definitely think that people are looking for, because there's overall in LP land, there's a shortage of distributions coming back. So private equity and venture obviously, have done really well, at least the markets have done well, but the distributions have been challenged. So what do you do to mitigate that? One thing that, people are doing is investing in credit. And so with rates pretty high, it's a pretty good time to invest in credit because obviously the current income pays your basis down. And there's nothing like a nice warm blanket of dividends that pay on a quarterly basis that in absence of the distributions, particularly on the VC side, but on the PE side too. So
look, as a real estate investor who likes contractual cash flow, you're speaking my language. I love the idea of monthly or quarterly distributions. I mean, we hear this a lot, obviously, from investors who are concerned that they over-allocated at a time that was perhaps top-ish and distributions have been slow. There must have been some managers who have done a good job with distributions. I mean, is this an opportunity for them to differentiate? I mean, how do you see, does this create a shakeup, I guess?
I think things like current income, shorter duration type of investments like liquid alternatives, hedge funds, public markets funds, and J curve mitigated strategies in secondaries. And then as well as sort of non-cyclical or less cyclical strategies are not as tied to the economic cycle. Things like insurance strategies, royalties, things like that, we've seen more interest in. But at the end of the day, if you're a good investor in whatever you do, no matter how much the rest of the industry is swimming upstream, you're going to raise your capital. And that's the case of, some of the managers that we're working with. Dan's working with a number of great managers that have returned more capital in the last couple of years than the history of their firm. So there's always going to be someone who knows how to figure it out.
Yeah. And that definitely in the past, year, 2 years, that is what resonates with LPs. That of course has been one of those tectonic shifts is everyone is focused now on DPI, right? Whereas opposed, it used to be just IRR or MOIC or whatever. Everyone is talking about DPI. And I think that we do see
DPI, I guess it resonates more than paper marks.
Indeed. Yeah. I do see you asked the question, Todd, like, what shifts we see now going forward. I do see some of the out of favor sectors. You mentioned growth, right? Or VC or growth. And certainly real estate has been tough. We do see some contrarian people, like we see some people coming back and real estate in particular, right? Where a lot of it has been working through the system and it's been slow, particularly on the fundraising side, particularly from institutional investors, right? We have seen institutional investors pulling back, if you will, from real estate or different segments of real estate. And I think that the family offices see that, take note of that, and in for a long-term perspective, this could be a good entry point.
Let's talk a little bit about how you guys have differentiated. You talked a little bit about this network effect and really taking the time to build trusted relationships with your investors. You've been at it for now over 10 years, which by the way, as a fellow entrepreneur, kudos, right, for hitting 10 years in your company. How have you managed to maintain those investor relationships, over a 10-year period, through periods of economic change, social change, across various countries around the globe? How do you do that?
I think maybe it's like you, Todd, right? Like you're passionate about real estate and we're passionate about relationships. You're also passionate about relationships, by the way.
Especially real estate relationships.
Yeah. Exactly. And LP relationships. But I think, the lifeblood of our business, we're not investors like you, is the management of relationships, the creation of new relationships. And if we don't do a good job of that, we're out of business. We're turning off the light. It's not only aspirational, but it's survival. I say survival because everyone is stepping up their game, whether it's Blackstone or the small startup, $50 million firm. Everyone knows how important investor relations and marketing is and how competitive the market is. It's getting even more competitive. So we have to find even more creative ways to engage with LPs. And one of the reasons why we create these global networks is because we know that investors, they like us, they trust us. Many of them have known us for a very long time, but there is a slight bias, right, to what we say about the markets, about the opportunities that we present them. So we open our LP networks to connect with other LPs because the biases don't exist. If they hear good things about a certain manager or about a certain market or opportunity from another LP, they're more inclined to think that that recommendation or that perspective is more objective. And as a result, like they think that perspective is more helpful if it's more objective.
Well, I'll say, just to toot your horn less, one of the things that I have heard from investors is that you do a particularly good job of that. And certainly, I would think if one were a short-term thinker in the world of placement agency, you just want to fill whatever fund you're selling right now. But if you were a long-term thinker, I would gather that it makes more sense to only represent funds that you actually think will work well and to only present those funds to investors for whom you think there's a logical fit, right, based on your relationship. And I think the fact that you go the extra mile of then connecting LPs with one another so that they could discuss amongst themselves without, sort of undue influence from you or from the manager. I think that's something that I've heard repeatedly in the market is something that you do particularly well. It seems that you focus on that. I presume that's intended to engender long-term trust. Now, Dan, maybe moving from the LP side to the manager side, there are a lot of LPs out there, but there are a lot of managers in a variety of different sectors. How do you decide which managers you want to work with? What are the characteristics that lead you to believe that they will be successful or that their story will resonate with investors?
That is very difficult to answer in the sense that it is absolutely an art much more than a science, right? Process maybe is similar to how an LP would underwrite a new manager in the sense of it is a variety of different factors, including many that we've talked about today. It is based on us and our relationship with the GP. Do we want to work together? This is a big benefit of being an independent firm. You can decide who you want to do business with. There's not people telling you who you have to do business with. That is a big thing we've all dealt with in our careers. I think that inspires us to be entrepreneurs. So that's certainly really important. And there's always a market side of it is, how much do we think we can raise? Is there a market fit? Because if we'd have the best GP, but if no one wants that asset class or that type of investment, then there's, then we can't help. Then we have no place in the ecosystem, right? So I think it's a mix of different factors and it's better as time goes on. I think this is something that is better as time goes on, right? You let a lot of lessons learned, a lot of battle scars along the way. And the relationship aspect is super, super important. I think we'll only continue to go that way.
So you touched on this, and certainly I've read a lot about this, that the current fundraising environment seems pretty darn tough, right? And the competition for deals is pretty tough. The competition for investors is pretty difficult. The logical conclusion is that being a manager, especially an entrepreneurial one who isn't associated with a long-standing firm that's been around for 30 years, makes it seem like it's pretty difficult. What do you think are some of the biggest obstacles, and what advice would you have for newer managers starting out or working through fund 1 or 2 or 3 or something?
Todd, I always joke with a manager that, especially a first-time manager, is that it'll take twice as long to raise your fund and you'll raise half as much. And if you're okay with that result, you're fine. Like, you're in the right mindset. And I only say that just because, as you said, it's a tough market. It's a competitive market. And not only that, like, the larger managers are in the AUM game and they're happy to take, fee breaks or, other concessions on terms, have fancy speakers at their AGMs, all these things that the small manager can't do. I mean, they literally can't do it because if they cut fees too much, they wouldn't be able to pay for their lights or for their payroll. I think you just go in eyes wide open, knowing that's going to take a long time, that it's going to take a lot of conversations. And it is about that first fund. But if you take a look at, I work at Blackstone, and they raised the largest private equity fund at the time, but it was still under $1 billion, their first fund 1. And what Blackstone later became known for is their excellence of returns that fueled larger and larger fund sizes to build what they've done today. They didn't even start off as an asset manager when they started day one. They were an advisory firm. And so to that point, I would say that always remembering where some of these even large firms started off day one, that all these firms started at relatively modest starts. And because they executed, they were long-term focused.
I'll turn the question. What advice would you give to an investor, an allocator, to find those earlier managers who are, starting out on fund 1, fund 2, fund 3, fund 4, the earlier guys who are more likely perhaps to get better investment returns? How do you help those allocators find the right managers so that they can get the higher returns going forward?
I would say that this is the good news, Todd. And that is that there is a whole world of allocators out there that are looking earlier and earlier to invest with managers. And I would say that they're not sort of small, dinky, high net worths or new family offices. They are institutions like endowments that are among the most mature and most sophisticated LPs out there, as well as family offices that are even looking beyond fund 1. Like, in some cases, some of these LPs have backed independent sponsors on a deal by deal basis. That number in many ways is growing exponentially. Most of the endowments that I talk to, many of the family offices that I talk to, and increasingly, more pensions, they talk about investing in smaller managers. In some cases, it's taken 4 or 5 years for us to get to know a manager from the time of when they thought about launching to when they launched to maybe their second fund or their 4th year in business for us to get to know them. So we keep, just like you build a pipeline of investments, we keep a pipeline of GPs that we try to stay in constant dialogue with. And that's how we try to sift out the best opportunities.
So I guess the thought there is perseverance, focus on the long term as a manager, and then as an investor, perhaps focus on those younger, more entrepreneurial managers who are focused on the long term. Let's switch for a little bit. I want to move to some extracurricular activities. Dan, you're the chapter head for the Kaya Association in Latin America. For those who don't know, Kaya is the Chartered Alternative Investment Analyst Association. So I guess Kaya is less of a mouthful. What are you trying to achieve with Kaya?
Yes, and thanks for mentioning that, Todd. We are trying to make the Kaya brand have much more awareness in Latin America. It has a lot globally. Latin America, we're a bit behind. I was one of the first Kayas in Latin America. I did it like 12 years ago, I think. And it was pretty transformational for me. I learned a lot and a variety of different things that have helped me since then. And I think today even. And so we're trying to just enhance the visibility of the brand. The private markets across Latin America have had tremendous growth, almost exponential growth, both on local markets as well as what we talked about earlier, where local investors are investing abroad into global asset managers. And Kaya is like the main source, but behind that, as far as like the allocator perspective, and we're trying to grow the community locally. We are doing quite well at that. The numbers have increased tremendously, and that's what we're trying to achieve.
Got it. That sounds totally consistent with your mission here of improving access to information for investors. Now, Les, your extracurricular is a little bit different. I teased this out at the beginning that you're a musician. You play in a band and you often play actually to raise money for charity. I think it's called A Leg to Stand On. Can you tell us a little bit more about that?
Yeah, I've been a musician since I was 12, but this new band is sort of a recent thing. So I don't want to make it seem like we've been doing this for a long time, but I hope I will be. It's a great organization. They basically provide prosthetics to kids in the 3rd and 4th world. One of the ways they raise their money is by hosting events in Chicago and New York, and they're going to be doing it in London in 2026, where people, like boring people in the investment industry like me, get to put bands together to raise money. It's now starting to emerge into a kind of a thing of its own. We've been asked to actually play other investment events, probably near and dear to David Rubenstein's heart, the Booth alumni kind of event in Chicago, the RFK
University of Chicago booth. Yep.
Yes. The RFK Investor Conference at Cape Cod, and then we'll be playing again in both Chicago and New York. So
sounds like Lollapalooza next.
Exactly. And we do this with a group of people in the investment business, both the managers and LPs. So it's just a nice thing to do. Get off the Zooms and get out of the conference room and get into the studio or on stage with, some of your peers in the industry. It's a great feeling.
That's great. And kudos for raising money for such an important cause as well. Let's now shift. We're going to go to our closing questions. And this is the first time I've done it with 2 guests. So let's try and keep it a little brief, rapid fire, just to go through these, but would love to hear your thoughts. Maybe each of you, a book that most influenced your thinking or your personal development.
I am not an avid reader. I would love to be, and unfortunately I'm not. The one that strikes out is Shoe Dog by Phil Knight, which is a story of entrepreneurism, a fun story. And my wife used to work at Nike, so there's a personal connection.
That's a great one. Real story of perseverance again. Les, yourself, a book?
Yeah, it's Outliers by Malcolm Gladwell. And I think it just underscores that, you make your own luck.
Excellent. Maybe we'll go reverse order this time. Best advice that you have received from your parents or that you give to your own kids?
So my mother told me the day I got fired from a job that everything happens for a reason. And that's led me to the path that I'm on now, because I started my job at Park Hill and Blackstone, and then that allowed me the skills to kind of launch Alpine. So my mom was right.
And Dan?
Hard work and leading or showing by example, I would say. Both that my parents taught me, my mother specifically, as well as I try to teach my kids.
Oh, with 7 kids between you, you'll have a lot of teaching to do, both of you. Now, final question. In the U.S., the Declaration of Independence, as you know, talks about freedom for life, liberty, and the pursuit of happiness. So what do you each do in pursuit of happiness? Dan?
I play sports. I like to, work out, play sports, be with the family, of course, is, most important, but all different sports, basketball in particular, has always been my number one sport.
And Les?
Yeah, I mean, me and my family as well. But, Warren Buffett's probably one of the happiest guys that we know. I mean, whether it's in the business or outside the business. And I think the reason why he's so happy is because he loves his job. And so Dan and I both love our job. And I think if you make your work happy, or you do something you really enjoy, you stay a happy person. And that's not to say that there's challenging times, but I don't know. We really love our jobs. And as a result, it really helps us stay in a good mood, both personally and professionally. So we work to stay happy.
I love that. I want to thank you, Les, you, Dan, for joining us today. I want to thank you both for your partnership over the years, but thank you especially for joining and sharing your insights on the world of investing. This has been a lot of fun. So thanks a lot.
Thank you, Todd. It's right back at you. It's been great. And thank you for all the trust and the partnership over the years.
This podcast is provided for discussion and informational purposes only, for use by Declaration Partners, LP, together with its affiliates, referred to as Declaration. The information discussed in this podcast may change at any time without notice, and there is no duty by Declaration to update any person to whom this information is provided. This podcast does not constitute an offer to sell or the solicitation of an offer to purchase any investment product or any interest in the fund or any other investment vehicles or accounts managed or advised by Declaration, a Declaration investment product, in any jurisdiction to any person. Any such offer or solicitation for interest in any Declaration investment product will only be made pursuant to such Declaration investment product's definitive offering documents, which contain a description of the material terms, including risk factors, conflicts of interest, fees and charges, and regulatory and tax considerations relating to such Declaration investment product, and which should be reviewed carefully by potential investors prior to making an investment decision. This podcast does not constitute tax or legal advice. The listener is urged to consult a professional tax and/or legal advisors regarding the possible tax, legal, economic, regulatory, or other risks and consequences associated with any investment, and must be able to bear the risks involved. This podcast may contain certain forward-looking statements which constitute Declaration's views with respect to future events, which can be identified by the use of forward-looking terminology such as intend, seek, expect, target, project, or endeavor. These statements are made based upon such views as they exist as of the date herein. There is no assurance that such views are correct or will prove, with the passage of time, to be correct. Actual events or results may differ materially from those contemplated by such forward-looking statements as a result of factors beyond Declaration's control, including, without limitation, any disruptions in global, regional, or local financial, credit, or real estate markets, acts of God, fire, hurricanes, tropical storms, floods, earthquakes, or other natural disasters, outbreaks of an infectious disease, pandemic, or any other serious public health concern, war, terrorism, labor strikes, electricity shortages, or other national or local emergencies, or any combination of the foregoing. David M. Rubenstein is an anchor investor in Declaration Partners Real Estate Fund II and is not an employee of Declaration. Neither the U.S. Securities and Exchange Commission nor the Securities Regulatory Authority of any state or other jurisdiction has passed upon the accuracy or adequacy of this podcast. No compensation has been awarded to any speaker for statements made that are either testimonials or endorsements. However, certain speakers may be current or former investors in certain Declaration investment products and may receive reduced fees, priority terms, priority access, co-investment rates, among other preferential treatment, which may pose a conflict of interest. Certain speakers may also be affiliates and/or service providers that receive compensation from Declaration for services provided in their service provider capacity, but have not been compensated specifically for any testimonials or endorsements made herein. All statements made on the podcast are the opinions and beliefs of the speaker and may not necessarily represent the opinions, beliefs, and position of Declaration. Consequently, from the foregoing, no reliance whatsoever should be placed on this podcast, and no decision including any investment decision should be made based on this podcast or on the information contained herein.